All right. Welcome, clients and friends, to the 2020 Borrowing to Invest seminar. Thanks for sharing your evening with us. Usually this session's hosted in person, but due to the present reality, we're hosting it online this year. As a reminder, the session will be recorded this evening. Now, normally this session I do every year just to educate clients who want to learn about a more advanced strategy once they have a financial plan in place. However, the timing this year happens to be impeccable as we have the largest drawdown in equity markets since the great financial crisis of 2008. Tonight, we'll start with an economic update from Steve Saretsky, where you can ask him questions directly. We'll then get into some history of the markets and a discussion around leverage investing as a strategy to build wealth. At any point, if you'd like to ask a question, please do so in the comments section, and we'll get to them when we can. So without further ado, it's my pleasure to have Steve Saretsky joining us. He does weekly YouTube blogs about the real estate market, and his research helps many Canadians, including myself, make more informed decisions about the real estate investments. Thanks so much for joining us today, Steve.
Yeah, thanks for having me on. Do you want me to kick it off with like a brief overview of the markets, or is that what you want me to do?
Yeah, I think that's a good plan. I just got pulled up your Saretsky report here, so feel free to jump into whatever you think's most relevant.
Yeah, for sure. So obviously, like, there's a lot of questions happening. People want to know what's happening in the real estate markets. So basically, the market was relatively quite hot heading into the pre-virus. A lot of multiple offers, and obviously that activity over the last couple of weeks has basically come to a halt. So what we're seeing right now is like new listings are down, dropping about 65%. Obviously, sellers are a little bit concerned about having people through their homes. It's obviously not a good time to sell your place. And now we're also starting to see sales drop off as well. So sales have dropped off in the last week by 50%. I suspect you should see April sales figures probably down 70%, give or take, from last year's levels. So long story short is there's very, very little happening right now in the housing market. Inventory is going to slowly start to build up because a lot of this inventory is going to be stale. And I think that obviously I don't have a crystal ball, but I think that there's two components there's two components that basically drive the housing market. Number one is liquidity and credit. So that's like basically the act is more being able to get a mortgage, what that mortgage rate looks like, how eager banks are to actually lend money. And then number two would be employment. So obviously having a strong labor market with rising wages is obviously beneficial for the housing market. So where we are today is obviously everybody knows, like, we lost 1 million jobs in March. Market. Number two is the bank's willingness to lend money. Obviously, bank lending in this environment is extremely tight, says our internet connections here. So yeah, as you can expect, is that obviously when people are getting laid off, nobody knows what the outlook looks like. Obviously, the banks are very conservative in their lending. So what we're seeing is a lot of new rules are being brought in by the banks to essentially, what they're doing is they're almost vetting the sustainability of your jobs. Even though you might be employed today, the banks are basically saying, well, if you're in any one of these sectors, which is, it's actually quite a long list, they might not give you a loan just because they're kind of worried about potential layoffs moving forward. So long story short is the housing market's basically on pause for April, probably for May as well. Once we eventually come out of these restrictions and get back to sort of more normal life, I suspect it's going to be pretty slow out of the gates. I suspect that the probabilities for downwards movement on prices is pretty elevated. Obviously, I don't know if for sure prices will drop or how much they will drop, but I think that the probabilities are pretty high given that the huge increase in unemployment. So that's kind of where I'll leave it. Obviously, if anyone has any questions, feel free to fire away.
Oh, thanks, Stephen. It was a great overview. I love how you bring economic data and facts to make hypotheses, and I think that's what most of us are looking for when we want to make these big decisions. So, any immediate questions, or should we jump into the rest of the content? Hearing none. Okay. Oh, hold on a sec.
It's a good time to buy your first property.
What do you think?
I would say there's no rush. It depends. Like, I don't like to give blanket advice, but obviously, like, what your situation is. Like, if you're happily renting right now, and you're just like, you want to buy it, but you're not really in a rush, then I think like time is probably on your side. You can probably take your time, slowly start looking, maybe throw in a couple of low balls, see if anyone bites. But yeah, I think over the next 6 to 12 months, I think that the outlook for housing is pretty negative. Obviously, again, can't predict prices, but I think if you're looking to buy your first property, it's obviously a pretty big decision to make. So just if you're going to do it, don't over leverage yourself. I would buy with the expectations that if you do buy today, that there's a significant probability that the prices could drop a bit, and just being okay with that emotionally as well, and having a longer term outlook. But yeah, I think like certainly there's no rush. I mean, I'm still seeing the occasional person, the occasional property go into multiple offers, which to me is a ridiculous thing to do. So if you want to buy, don't be competing in multiple offers. Try to go in, find a seller that's a little bit more motivated to sell, and see if you can negotiate the price down.
No, that was a great response. Thanks, Steve. Any other questions before we carry on? Okay, good. So what I have here, and this was included in the calendar invitation out to everyone, is just a list of cumulative returns, 10 years from the headlines on these headlines on Time Magazine. And the reason I sent this out is we're emotional. Humans are emotional, and we make decisions sometimes based on our feelings as opposed to based on facts. But these are facts. These are cumulative returns, 10 years following the dates listed. And so for us, we're living in, for many of us, this is maybe our second recession. Maybe some older gentlemen on the call might be your fourth or fifth. But when these recessions hit, it's an opportunity for us to potentially make some money if you're in a good financial position to do so. And so the purpose of today's session is to educate you a bit more on how leverage works and how you can get these types of rates of return in your portfolio over the next 10 years. At the end of the day, it's important that you try to ignore the headlines. All of us are probably signed up for Yahoo Finance or Global News, and we're getting inundated with information about negativity surrounding the coronavirus. And whether it's coronavirus or swine flu or 9/11, there's always going to be something that the news is advertising. But if you get scared and get out of the market, there's a much higher chance that you're actually going to lose out by doing so. And so at the end of the day, staying invested through the times like this will be your best play. But no, adding leverage when things are on sale is going to greatly enhance your rates of return long run. So all of my clients that are on the line, you all have a financial plan in place. What that means is you've got stable cash flow, you've got good liquidity, you've got retirement income, your income's protected, and you've got some insurance in place so that your family would be taken care of. That's a financial plan. All of this is important before you look to borrow a bunch of money and put it into the market or buy a piece of real estate. And so none of this goes out the window in a time like this. This is cornerstone. This is really the foundation before you make any large investment plays or borrow a big sum of cash. So what is leveraging? Essentially just borrowing someone else's money in order to buy an asset. So common example, as Steve's alluded to, is buying a home. If you're buying your first home, you're going to get a mortgage. Mortgage rates are pretty good right now, but you are leveraging when you do that. You can also leverage into the equity markets. So that could be putting money into stocks that are at depressed prices. with the expectations of enjoying future growth on those investments, as well as the dividends along the way. And the premise here is by borrowing money, you'll actually be able to get more of a rate of return in the long run than if you just were putting your own monthly savings into an account. And I'll run you through a couple numbers to show you the impact here. So what this graph is showing you is that the difference in investment of either starting with a $125,000 loan and allowing that to grow versus simply saving $416 a month, which is a little bit more than what it would cost to actually borrow this sum of cash. So who are the people that should be leveraging? Sorry, I think the sun's kind of blocking me a little bit here. I don't do as many videos as Steve, so I don't have the same setup. Okay, so the people that should be leveraging are those that have limited RRSP and TFSA contribution room. They want to enhance their retirement income with non-registered money. They want to have a tax-effective strategy to help them grow their wealth, because interest on non-registered investment loans are tax deductible here in Canada. People are retiring earlier, they're living longer, so they're going to need more money in retirement. If you don't understand how the system works and use the system to benefit your financial situation, you're going to have problems down the road. A 30-year-old with a retirement age of 60 and a life expectancy of 85, if they need 40,000 bucks a year of net income in today's dollars, which isn't a crazy amount, they're going to need to have about 1.5 million bucks. So who's the right investor for leverage? Generally, people who would be a good person for the strategy, they understand market volatility. They've been through some ups and downs and they haven't made rash decisions. They're able to withstand those fluctuations in the short term. Business owners and entrepreneurs are usually quite suitable for the strategy because they're quite familiar with borrowing to invest, generally for their businesses. They understand cash flow requirements, the necessity of maintaining adequate financial reserves for emergencies. So this is an excellent strategy for investors who are looking for additional ways of reducing taxes, as I mentioned. However, this should only be evaluated once other financial planning methods are in place. So you should already be saving in other different accounts before you look at leverage. This should be a strategy you look at when you already have a plan in place. This isn't something you just start with. Anyone who I help with this strategy, they need to answer yes to these questions. Do they have a solid financial plan in place? Can they withstand market volatility? Is their income stable and protected? And lastly, have they factored in any of the potential what ifs? Do you work in the hospitality industry? Is there a good chance that your job's going to be gone in a few months? We probably shouldn't take out a big loan. Okay, so the benefits. CRA does allow tax deductibility for investment loans. This is the same for rental properties as well as for non-registered investment loans. Now, CRA could change their position on this, but it's been like this for as long as I can remember. And I know we've got an older gentleman on the line, Brian Gebby. I don't know if it's ever not been the case, but recent memory, CRA has allowed this tax deductibility to be the case. And I don't expect they would change that when business investments are decreasing, like we're seeing in a recessionary environment we are now. Maximize portfolio growth. So we showed you that graph, the difference of starting with 125 grand versus just putting in monthly chunks. We're also in a low interest rate environment. And Steve, he's quite involved on Twitter. I follow him. He chats with Evan Siddall. Well, Evan doesn't seem to respond very much, but
Trying to get him.
Trying to get him. Evan Siddall's the chair of the CMHC, or he's on his way out, I think. Seems a lot of these guys are probably trying to get out given where things are at. But anyway, interest rates are low, so it's not a bad time to borrow money. What are the risks? So once again, this strategy, it's very much for the risk tolerant client, but the markets are going to go up and down. You got to be able to see a a down market and not panic and want to sell your investments. That's you, probably not the right fit for this type of a strategy. Interest rate risk. So yeah, interest rates are low now. They may go up. They may stay low forever. I think a lot of the central banks have kind of pigeonholed themselves now. And we look at Japan and we look at Eurozone, they're already negative. Real rates were already negative in North America, but they must have to try to increase them at some point. But I don't see this as being a risk where you say, well, they're going to raise them, so therefore I'm not going to borrow any money. It's more just understand if they do raise rates, how is that going to impact your monthly cash flow? And are you going to be able to handle that? Cash flow risk. So once again, is your job stable and protected? If it's not, you might want to evaluate not leveraging yourself too much. It's not to say you shouldn't leverage, but just do it to a point where you can manage with your cash flow, even if you were to say lose your job for a few months. Consideration. So always consult with a financial planner before doing these types of strategies. Don't just jump in and think it's going to all be good. You want to factor in all the what ifs before you start, because you don't want to be in a situation where you need to sell an investment at a loss and owe a bank money. That's a lose-lose situation, except for the banks, of course, because they win no matter what. But markets, they're going to go up and down. At the end of the day, this is a long-term strategy to make sure you stick to the program and try to think beyond the short term. So the programs that I have available offer 100% financing of investment funds between $10,000 and $250,000. The banks will review the loan applications over $100,000 quite thoroughly. So I often will do $100,000 for clients. They are in a single disbursement, meaning that you get the money right away. However, with some clients, I have been dollar cost averaging that money over the next year, and I have done that in the past, depending on what's going on in the marketplace. The investment loan companies I work with, National Bank and B2B, they don't do margin calls, which is important. So if your investments are below the market value, or below your book value, they're never going to call you and say, hey, Steve, I want $50,000, because that's a terrible position to be in. Versus your brokerage account with, say, Questrade, that is not necessarily the case with those guys. They're probably going to ask for a margin call if your investments are below value. So I try to not lose friends in my financial planning business, so I don't put clients into situations where they're ever going to get a bank calling them and asking them for money. Okay, so with regards to the program terms, we can do 6 months to 5 years. Generally, I say look at a 7 to 10 year timeline for this strategy. You want to be able to ride out a market cycle, enjoy the fruits of your labor and taking the risk. We can do fixed or variable rate, but generally we do variable. Right now I'm seeing prime plus a quarter, which somewhere in the neighborhood of 3%, which is pretty low. Do you think we're going to get more than 3% growth on equities in the next 10 years? I think probably. You can pay off some or all the loan whenever you want. There's no limits on that, but of course you'll lose some of the tax deductibility whenever you pay off a portion of the loan. Okay, quick strategy here, and if any of you guys have questions, feel free to pop them in the comments. RRSP versus leverage investment. So we'll compare investing $5,000 a year with a 35%, a client with a 35% marginal tax rate, 8% annual return on investments, 4% on the investment loan. So if we were to just do $5,000 a year into an RRSP, that's going to grow and over the course of 25 years be approximately $388,000 in that RRSP. Now we'll look at a combination. So what if you did $2,500 a year to RRSP, $2,500 towards interest on an investment loan? And that would be, actually quite a bit more than 62.5 with the present interest rates. So in 25 years, that $2,500 a year would turn into $224,000 in RRSP if we were looking at an 8% rate of return. Plus, we'd see $428,000 in a non-registered plan. But of course, we'd have a loan to pay off as well. Now let's look at $5,000 per year on a $125,000 investment loan. Result there is about $734,000 in non-registered investments. So let's just compare these three: RRSP, combo, and leverage. RRSP about 388, combo 652, and leverage 734. Now, of course, we got some taxes to pay. We got to pay the loan back. So what's our net after tax dollars in accounts? 252, 447, 536. Now, is this to say that you shouldn't do an RRSP and you should only do leverage? No, this is just to show that with the most risky strategy, you get rewarded the most. So generally what I'll recommend clients is it's one portion of a variety of strategies. Our overall objective is to allow clients to grow their money at the level of risk they're comfortable with, understanding how the tax rules work and abiding by those to try to get you ahead in life. Okay, so that's all I got from a content perspective. Let's open the floor up to questions. I know most of you guys, you're usually not this quiet. John, please go ahead. You can unmute your microphone. Actually, I'll unmute you. Yeah, you're good. You're good.
There you go. So Brandon, what typical security is the financial institution going to be asking for?
Oh, right. So the security that the bank is going to ask for is the actual investments themselves. So this will still go on the credit bureau. An investment loan will still be on the credit. So if you were to apply for a mortgage, it may reduce the amount you qualify for. But the assets are directly tied. The assets you invest in are directly tied to the loan. So you would not be able to sell some of the investments and take the money without the bank approval and the bank getting paid first. But generally, mutual funds are segregated funds.
So that raises a second question. So if I've hypothecated the investments that have been made, I have to get the bank's approval before I could theoretically liquidate them. Is that, did I hear you correctly, or am I?
Correct, yes.
Okay, all right. That's all the questions I have at this time. Thank you, Brandon.
Okay, thanks, John. Okay, we got a question from Brock. Could you hypothetically take out a $100,000 leverage loan and increase that in the future? So banks, the way they look at these loans is they see it as an application every time you ask for money, and it's a new application every time you ask for more money. So they won't allow you to do one app and get 100 grand and then a few months later get another 50 and it's all included in the same. It'll be considered a second loan, second disbursement. So they would need to requalify you at that time, and it would be another credit hit. So generally, I say if we can, try to borrow all at once if you can, because we don't want to see your credit get hit too hard. Good question. Does the bank value the investments at 100% of their value when doing the stress test to qualify? That's a great question. And I don't know if Kevin is on the line or not, but he's a mortgage broker I work with.
Yeah, I'm here.
Oh, Kevin is here. Awesome. So Kevin, Kevin's a great mortgage broker I work with, and he's helped a number of my clients. The question Ryan's asking here is if the bank would value the investments at 100% when doing the stress test. And I think it might be different, but please let me know your thoughts here.
Yeah, so like with regards to applying for a mortgage, like if you had that investment loan as well, they would definitely use that for their qualifying figures, right? For their TDS and like their debt qualifying figures. Is that what the question was alluding to?
Yeah, and I guess would they value the assets at the same level?
They
so
wouldn't. No, yes, they would use
the
the debt servicing. So what they would use as a debt servicing would be the interest only payment. So if you're buying another property, they would take that interest only payment as part of the debt servicing.
Gotcha. And so the assets wouldn't necessarily negate that.
They wouldn't negate it, no, but it would strengthen the application because it would obviously show a stronger net worth.
Yeah, and I guess certain lenders might do things differently. Who have you been using lately? Like who's been quite lenient these days in comparison to, like, are the big banks the best, or have you been using more smaller lenders?
really depends on the situation. For those that are looking for access to liquid cash through a home equity line of credit, we've been using Manulife quite a bit for them. Scotiabank as well. So those are probably our two primary. If you're looking to leverage, your home equity as part of this investment profile and having the ability to just kind of draw off it when you want it, it gives you the most flexibility. And you're looking at an interest rate of about 2.95 right now, at a prime plus 0.5. So yeah, it creates that flexibility. I think you had one of your clients asking if you could, ask for additional money. Going down this road with a home equity line of credit is going to give you the ability to kind of use it at will, and not having to contact the lender to sell off your assets and your investments. You would have full control over that in this scenario.
Yeah, no, that's a great point. Like this investment loan program that I have, it's good because the interest rate's low, but it doesn't give you a lot of flexibility. So, make sure you got a home equity line of credit set up if you don't already, because this is really just a portion of someone's debt. And a guy like Kevin will help optimize all your potential debt obligations to make sure you're getting the best rate. So thanks for sharing, Kevin.
Yeah, for sure. Thanks, man.
Brian's asking, what would be a good threshold to begin consider leveraging to purchase a second property? Steve, what do you think?
A good threshold to begin to consider leveraging, purchase a second property. I don't know. It feels like a little bit vague to me. Like,
so I guess if you already have a property and you're thinking about, you've got some equity in the property.
Equity?
Pardon?
Tapping into that equity.
Yeah.
I know the banks have changed their home equity line rules.
Yeah, you're gonna, if you want me to jump in on this one, Brandon, it's if you're gonna need to, if you're leveraging your equity in your current home, you're gonna need at least the 20% down to buy an investment property.
You have to do that through a refi now, right? As I know the HELOC, the banks are shutting that down now with the HELOCs, right?
No, the HELOC, you can go up to 65% of the value of the property. So you can take HELOC out of 65% of the value of the property. So say you had your home and say you had, it was at 50% loan to value in your home, you've got 50% equity in it. And you had a HELOC on there, you could take that HELOC, draw as much as you needed off of it to put the 20% down on your next purchase, which would be an investment property.
So what I've been told from some lenders is that the big banks have shut that down now on investment properties. I could be wrong. Maybe
I'm talking about a HELOC on your principal residence to use that money to put down on your next purchase. So you need
I had heard that I got shut down, but that could be only at certain lenders at this point.
Yeah, no, you can do an investment property with Manulife. It's just they charge a higher rate for it. So instead of 2.95, they put you at 3.3, I think, right now.
Okay, so Manulife still did that. Okay.
Yeah, it's just a higher risk profile for them.
Yeah, I think I talked to was it Scotia, TD, and RBC are not doing that.
Yeah, there's a lot of banks that have pulled out of it, but it is still available just through other channels.
Oh, okay, nice.
Gotta get that money approved now before the banks pull it all.
Yeah, no, they've been pretty good. Obviously they're all adapting to the new environment, but they haven't been backing out a lot of files, especially the insured files. So if the clients were down, everything was approved, they're not going back to checking. So if somebody had an approval and it's closing, say in 2 weeks, they're not going back to check if they're still employed. But all new files, they're looking for income documents like right up front before.
Yeah, Kevin, is it April 9th moving forward, right?
What's that, sorry?
Was April 9th was the cutoff, right?
Yeah, so like anything moving forward, yeah, exactly. So now they're obviously vetting it a lot more, but anybody that was purchasing prior to that, they're not going back to double check that you're still employed. Yeah.
So yeah, that would be a disaster if they did.
Oh, it would total disaster, right? So, and they're a lot more lenient on the insured. So anything that's backed by the government, they're a lot more lenient on, for sure.
Yeah. makes sense.
Yeah, at the end of the day, none of us have a crystal ball, right? We don't know what banks are going to do, what the central banks or the Big Five. We don't know for sure, but all we can do is look at the set of facts in the market today, and that there's a coronavirus. People are chilling at home. Lots of companies aren't making money. Government's funneling a bunch of money into the economy. They did react to the coronavirus a lot faster than they did to the great financial crisis, in that there's $2 trillion being pumped into the market in the US, over 100 billion here in Canada. There's repurchase programs being done by both central banks. Asset prices will long run go up. It's not the end of the world. So, while it is a bit of a Ponzi scheme, I think as Steve might have said, it's just the game that we play. And, you can choose to sit on the sidelines and say it's not fair, or you can learn the rules and play. Okay, John is asking, are you seeing banks reducing real estate secured HELOCs?
But Kevin can probably take that.
Yeah, Kevin, do you have you seen that?
Reducing like the loan to value on them? Is that the question? Sorry.
Yeah, I think so. So
yeah, so they're still offering HELOCs at 65% loan to value. What's playing effect now is obviously the appraisals. So the whole appraisal market, they're adapting pretty quickly to that. So we're still getting appraisers through, but in more of a technology way. So the owner of the home would pretty much be doing a FaceTime with the appraisal company going through the home. Where we see a challenge is as real estate transactions are limited, it's finding those proper valuations, right? As we get further into this and less transactions happening.
Thanks, Kevin. Have you seen any lenders that are cutting back? So if they've issued HELOCs, they're kind of saying, hey guys, we're going to reduce the amount of available credit, or anything that's already been approved?
No, nothing. No, anything that's approved is approved. No, none of that gets scaled back.
Okay. And in 2008, like, did that happen? Did banks kind of reel in their balance sheets and say, hey, we approved this, but we can't anymore? Or was anything like that done, or
no? I think we are quite healthy in the Canadian marketplace. I can't really speak to the American marketplace, but we didn't see much scaled back. Obviously, there was a lot of programs that got rid of. Like we used to do zero down, purchases and 40-year amortizations, and we all know over the last 10, 12 years since then, a lot of those programs have been reduced. We've now got the buffer on qualifying, so we're not using contract rate anymore. We're using the contract plus 2%, or using the benchmark rate that the Bank of Canada announces. So they're all added security to stabilizing the housing market, really.
Brian Gebby, you're on the line, right?
I am. Yeah. Hey, Brennan.
Hey, Brian. So Brian, you had a bunch of clients in the market in 2008, and some of them were probably leveraged. How did that go for them? Because we're kind of mid recession potentially now. We may be on the way back. Who knows where we're at? But back in 2008, what was the emotional roller coaster like for you as an advisor then?
Yeah, I think, if you think even leading up to it, thinking back to 2007, I know you talked about obviously prime now at 2.45. Back then it's hard to believe, but it was 6%. So, we were doing, a lot of leverage loans even then. And obviously when the financial crisis hit, when you're leveraged, it maximizes returns, but magnifies losses as well. So, during that time, as you spoke to it, it's not a get rich quick strategy. This is something that's going to complement existing, wealth strategies, TFSAs, RSPs, real estate, like Steve talked about, and really just to position it to enhance retirement income. People are looking for other ways to, reduce taxes. We know we pay an enormous amount of taxes in Canada, and the more money you make, you pay more. So this is a great way, if you start maxing out RSPs or limited contribution rooms, that you can obviously find a way through this strategy with the deductibility to reduce taxes. So, going back to your question, I think there was a lot of fear back then. There's a lot of fear now. But when there is times of fear, there's opportunities and things are on sale. And with regard to my clients back then, it was just really sitting down and reassuring them. The world wasn't ending. It was still a 15, 20-year plan. I remember even back then having a couple leverage loans that people took out, and at the 100K mark, and they were down. I remember one was down to $63,000. Pretty crazy, right? And sitting down with them, revisiting and talking about the purpose of it and the reasons of why they did it. Everyone stayed invested, and now we look back 12, 13 years later, and everyone's in a very good position. But at the same time, coming back to the program where you talk about no margin calls, that is massive. I know there's a lot of other leverage programs out there that do have margin calls, so that's something that someone can be very confident of, that if it does drop, the bank's not going to call the loan. So again, it's not a get rich quick strategy. I always actually term kind of this strategy as conservative leveraging. It's not leveraging of investing in one stock and flipping it the next week, where I know a lot of people are trying to do right now with airline stocks and cruise line stocks. But this is something that's well diversified, that's in a well balanced portfolio. That's again, just like real estate. Steve said, if people invest in real estate because they believe it's going to appreciate. Well, it's the same thing with equity markets. If we believe over the long term, and I think most of us do, if we look back, that it will appreciate again. So stick to the plan, and you'll be better off.
Yeah, I guess that was a great summary, Brian. I appreciate it. I wasn't managing clients back in 2008, so I appreciate you sharing your perspective. Now, it's almost like real estate has been the asset class of choice for central banks around the world, because mortgage rates are so low. It encourages people to get mortgages, and that increases the credit growth, increases the price values of these properties. So yeah, is that going to be the case forever? Steve, what do you think?
Yeah, I mean, as long as it can kind of go on, it's obviously, I think that financial markets have kind of become detached from the economic fundamentals underlying them, as we can see case in point today. Record unemployment, record contraction in GDP, and everyone's worried about missing the bottom. So yeah, I don't know. I think it's central banks are obviously taking unprecedented steps, and whether that's buying up mortgage bonds to support the housing market, or that's buying junk credit to support businesses. And it is, like I said, I think we talked about it before this call, is what it is, and you just kind of have to play the game and understand what the rules of the game are, and how the rules are changing, obviously, and just playing in that framework, and obviously just being cognizant as things change. But yeah, I mean, obviously, I think Vancouver's always been desirable. Property market's always going to be expensive. Does that mean it's not going to have a drawdown? No, definitely not. But yeah, again, it's all about time horizons.
Yeah, that's a great point, and I think diversification comes into play too. If you've got 3 properties in Vancouver, you're probably laughing if you bought them 20, 30 years ago. Moving forward, is Vancouver real estate going to be the best asset class? It could be, but it might not. So you might want to make sure you got some real estate in other places other than Vancouver. Make sure you got a healthy stock portfolio. Yeah, make sure that you're diversifying. Start a business, different streams of income. That's at the end of the day what's going to save you, no matter what happens in the world. At least you'll have a few different options if shit's hitting the fan in one particular segment or market.
Yeah, no, I think that's a good point. Obviously, I don't know. One of the things I'm thinking about a lot is all this money printing that's going on, fiscal policy, is that we're obviously fighting massive deflation, but at what point does that transition into inflation, and interest rates have to start moving up, and that's obviously going to change asset valuations, and people have to position for those. Yeah. So, I mean, I don't know. Nobody knows what the outlook looks like, but certainly for real estate, for at least in the short to medium term, it seems like rates are going to be lower for longer. So.
Yeah, I remember seeing rates start to come up back in 2017, 2018, and I was like, oh, I wonder how far they're going to go. And you know, in Canada, we kept rates on hold while other central banks started to cut in 2019. I think we're feeling the pain now. Look at the TSX and households, but I don't know. My personal opinion, I think that was probably for the best. Canadians needed to try to deleverage because we didn't in 08, but you know, what now? Like, what do you think, Steve? Because we got Polos is leaving soon. I don't know much about the new incoming central bank chief, but are they going to be bullish, bearish? What do you think?
Yeah, I didn't get very far. Yeah, I don't know. It's probably going to be Carolyn Wilkins, I would think. So she's kind of the right-hand man to Pelosi. Yeah, I don't know. I think that, you know, I don't know. My personal view is that policymakers just kind of go back to the same well, and that's just the easy way out, which is just to basically print money and try to paper over the debt problem. And yeah, again, like, you know, it's hard to fight against that. So, yeah, I think at the end of the day, it's just have your money invested, right? Like, that's my personal view. Whether you want to buy real estate through me, or you want to go into stocks or gold or whatever the hell you want to buy, it's just like, obviously you can see when they're printing this amount of money, like, just get out of the currency.
I'm with you. I think John had a question.
Yeah, no, I was just going to say, obviously, inflation's got to come back sometime soon. They just can't keep printing money at the level that they're doing, and I believe we're a long way out of the the end of this COVID thing, and the government, federal government's and provincial governments are going to be pouring copious quantities of money at these problems, and the piper will have to be paid someday. I mean, never mind looking at the U.S. So anyways, I didn't want to get warped into that tangent, but my suspicion is we'll see inflation coming back.
Yeah.
Which help the markets.
Yeah, the interesting thing is just the velocity of markets. So, you know, stock market typically always reacts a lot faster than, say, the housing market. The drop was unfathomable. The March was the most brutal March ever, to my understanding. So, you know, we'll see what happens next. Real estate's a slower moving behemoth just because you need sales to dictate prices. If there's no sales, you don't know what the value is. But if we were to say unemployment continues for another 6 months, I think it'll be interesting to see what happens to folks who have big mortgages in, say, Toronto and Vancouver, if they can't meet their debt obligations and banks are not giving them more money.
Yeah, it's a good point.
Cool. Well, you know, if there's no other questions, we might be able to wrap up there. So I'll put one last call out to everyone.
I think Bakker's got a question.
Oh, Bakker, yeah. Would you recommend taking out a loan for investment before having a mortgage for the first home? You know, I think it depends on your situation. I think that if you're already going to be, it's going to be tight for you to qualify for your mortgage, then you probably don't want to get an investment loan prior. While I'm quite confident in 10 years, the market's going to be up and anyone who does this type of strategy is going to do very well. I can't guarantee that over the next 1 or 2 years. So to leverage and hope it goes up so that you could use that equity in the next property, it's a bit too risky. You do need to have a bit of a longer term time horizon. If you've got a good income and you don't need all of your TDSR, then yeah, you could potentially do leverage now and get into your property in the next couple of years. But you need to consider them separate and not dependent on each other. Good question. Okay. Well, I just want to thank Steve, thank Brian, thank Kevin, and thank all of you for joining us today. Hopefully you got something out of the session. I will have this recorded, so I'm going to send it through to those that couldn't make it in today. Please do send me some feedback if you liked it, if you didn't, anything we could improve on. This is my my first webinar for this type of an event, and maybe we'll do more of them. I tried to get Steve in the office, but he said he didn't want to come anywhere near me. So we'll try it again sometime soon.
Yeah, thanks for having me on, man. Appreciate it. It was good.
Thanks, Brennan.
Yeah.
Thanks, Brandon. Great job.
Thanks, everyone.
Thanks a lot, Brandon.
Yeah.